Hello and welcome to our latest edition of Bond IT Insights in 10. Thank you very much for joining us today. I'm Kerstin Völkel and I have with me today my colleague Dan Taylor, who's our head of Americas at Bond IT. Today's topic is preserving wealth in uncertain times. Rising credit risk certainly presents challenges for today's investors, but we think there's still opportunities in the market for good and stable returns. So, but no, not all opportunities are created equal. So certainly, investors should be watchful and selective in terms of their asset allocation. Today, we'll take a look at the latest credit risk trends and why bonds should play an important role in asset allocation, and also how technology can help investors with delivering more stable returns. So let's dive straight in and let's take a look at our latest Scoreable AI credit risk indicator. So for those who are joining us for the first time today, Scoreable is our credit risk analytics technology. It uses machine learning and AI to predict the rating transition probabilities of nearly 3,000 corporate and financial issuers across the globe. Our latest quarterly analysis does show elevated credit risk across the world. As you can see in the chart, there is a concentration of industries in the medium to high risk bucket, which does show heightened downgrade risk. It has certainly been a very challenging environment for many companies. Production and operating costs have risen a lot over the past year and a half. We had some good news from the US yesterday, certainly where inflation has come down, but overall, inflation figures have just been very high across the globe. And there's also still a lot of economic uncertainty, and also all that puts pressure on disposable income. So all these factors certainly impact the outlook of companies. And as you can see in our chart here, specifically companies that manufacture or sell household goods and products, they are in the highest risk bracket with respectively 26 and 28% downgrade probability. Also, other industries such as airline, tourism, apparel, they're all displaying a very high level of credit risk currently. And if we take a look at our analysis of falling angels, we can see that falling angels, the risk of falling angels is also on the rise. So currently, 13.4% of our BBB minus rated issuers in the Bond IT universe are at risk of losing their investment grade rating within the next 12 months. That is nearly 2 percentage points higher than it was at the beginning of the year. Again, just a reminder, we look at corporate and financial issuers here, and we see the highest probability of falling angels in emerging markets. So nearly a quarter of BBB minus rated corporate and financial issuers in emerging markets have a high or very high risk of downgrade and could lose their investment grade rating in the next 12 months. It's all in all, it's certainly a very challenging environment for investors, and all the more reasons to regularly check in what you own. And with this, I pass on to my colleague, Dan.
Thanks, Kirsten. As you can see from the title of the slide on the screen, it's sort of a reference to the Hippocratic Oath in the medical community, which is, first, do no harm. In this case, first, preserve wealth, particularly at the front end of a potential turn in the credit cycle. The search for yield in fixed income, as everyone knows, is well underway. The last 12 months have really brought fixed income back into the investors' dashboard, where it hadn't been for over a decade, with the Fed having rates pinned at zero. But now that inflation is up, rates are up, and now credit spreads are widening, there's a lot of yield on offer in the fixed income market. The key there, though, is for investors to realize, particularly for financial advisors, is that not all bonds are created equal. And while adding yield to portfolios, very often that's a simple search for yield. But searching for yield without reference to creditworthiness is a recipe for disaster. The role of bonds historically in investor asset allocation is to offset the volatility that's available or that comes from stocks. So higher return, higher volatility in stocks, lower return, lower volatility in bonds, and particularly in high quality bonds have often been the sort of destination of choice to actually diversify some of that volatility in equity portfolios. And frankly, a simple but effective way to stay invested during and through a credit cycle, stay safe effectively, is to construct your own high quality bond ladder, as opposed to being exposed to the sort of vicissitudes of the various ETFs and mutual funds that are actively managing their portfolios for different effects. Often constructing your own individual bond portfolio ladder is a very simple and effective way to manage through a credit cycle and a rate cycle. Everyone ought to be familiar with dollar cost averaging in stocks. It's a simple but effective way to sort of keep invested and keep investing at different levels of equity market activity. The same thing is true in bonds. When you construct a high quality bond ladder and continually have bonds maturing off at the bottom of that ladder and reinvesting them into the active bonds throughout longer maturities, you're always reinvesting at market rates and market credit spreads, so that it just keeps you in the market portfolio, which is where you want to be through a credit cycle. Of course, our Scorable AI credit software and Frontier portfolio construction software, they work together to continually monitor holdings in a portfolio and allow you to construct the ladder that you can be comfortable that will perform through a credit cycle. So first step in preparing yourself for a credit cycle is knowing what you own in your portfolio. With Scorable, our AI-based credit software, your portfolio is continually monitored for rating downgrade probability and relative value. As you can see in the graphic here on the lower left side, you've got a quadrant where the bonds in this case are identified as sell opportunities, whether they're in your portfolio or whether they're bonds in the market that you don't want to go near. These are bonds where the Scorable model is projecting a high downgrade probability and are still trading through, meaning rich to their rating and industry adjusted peers. If these bonds are in your portfolio, clearly they want to be rebalanced out of the portfolio. And as you can see on the graphic on the right-hand side, all those same bonds are listed across the various sub credit grades from AAA all the way down to CCC. The idea being rebalance out of those high downgrade probability bonds, and our Frontier portfolio construction software effectively allows you to do exactly that. In the graphic at the top, right near the middle, you can see downgrade probability listed high to low. These bonds, all portfolios are effectively scanned for and sorted from high to low downgrade probability. And then in the graphic at the bottom, rebalanced out of the portfolio and into higher quality, lower downgrade probability bonds. You can see the notation on the left-hand side of the lower graph saying sell all. You can, of course, have control over those individual bonds, which you want to sell and what you want to do with them. But initially, it will prompt you to rebalance out of the bonds that are projected for downgrade. And then importantly, what bonds do you want to replace them with? You can effectively replace those high-risk bonds with low-risk bonds using our credit model and portfolio construction software while increasing yield in the portfolio. So there's a right way to search for yield in your portfolio, and there's a wrong way to do it. The wrong way to do it, as I said earlier, is just to search for the highest yield and add those bonds to your portfolio. Again, a recipe for disaster at the front end of a credit cycle. The right way to do it is to search for yield in the market, but have a view to the downgrade probability, aka the risk of those bonds, and combine your analysis into risk-adjusted return. So risk-adjusted yield effectively. And Scorable, in conjunction with our Frontier portfolio construction software, effectively does that for you, but allows you to have control over that process as well. We're going to leave it there. We've always been sort of a quick 10-minute, and we're going to stay on time today. We want to thank everyone who's been able to join. Obviously, to the extent you want to discuss any of these credit trends further, you can reach out to me, Dan.Taylor at bonditglobal.com. You can reach our website, bonditglobal.com, request a demo, request a trial, speak with one of our salespeople. Happy to have those conversations on an ongoing basis. Fixed income is in the crosshairs with respect to investment opportunity now, but the key is taking advantage of that investment opportunity in the right way. Thanks again, everyone. We're going to sign off now, and we'll look forward to hearing from you in the days and weeks ahead.
Thank you very much. Bye-bye.